Hi, this is Pat O'Connor, the broker owner of the Veritas Real Estate Group, coming to you with my weekly video. This one targets real estate investors who are looking to defer paying capital gains tax when they sell their real estate investment property. The 1031 section of the Real Estate Code lays out the rules for the process for deferring the capital gains. And if you can have more money in your pocket by doing this, then you might want to buy more real estate properties. You can build up a portfolio. You can benefit from the multiple income streams. You have passive depreciation on these properties that will reduce the income taxes. And you can deduct your homeowners or your rental properties insurance and major repairs. So capital gains tax rate is lower than personal income tax. So if you can shift the burden of tax from personal to capital gains, you're going to save money. Now in 2021, the capital gains tax rate is 0% if the taxable income is less than $40,401. It's 15% if your personal income is $40,401 to $445,850. And it's going to be a maximum of 20% if your taxable income is greater than $445,850. Now, your personal income tax bracket's going to be higher than 20%, if you're making $500,000 a year. So shift as much as you can to take advantage of the capital gains tax. And you can't do this with your personal residence. If you have lived in a home for 2 of the 5 past years, you already have partial exemption from paying taxes. If you're single and you're filing, you're exempt for up to $250,000 from paying any taxes on that profit. If you're married filing jointly, you can be exempt for up to $500,000. So you can't exchange the personal residence. So it has to be an investment property. Commercial, vacant land, or residential. It doesn't matter. So just hold it for longer than 1 year so you'll qualify for this deferral of capital gains tax. Invest the profits in one or more like-kind properties, residential, commercial, or vacant land, mix and match between them. You don't have to go commercial to commercial. Just any mix and match. You cannot handle the money yourself from the sale proceeds. You need to give it to a qualified intermediary. It's a third person who is not affiliated with you, not your attorney, not your real estate agent, none of that jazz. It's a neutral third party. And they're going to handle the proceeds and transfer the escrow money to the closing company when you're ready for closing. The capital gains are finally due when the properties that you've been exchanging are sold and not exchanged. So you can keep, selling them and exchanging them and deferring the capital gains tax till you die. Let your heirs worry about it. But, so you can keep doing this until you finally decide, to sell the property instead of exchanging it. So like kind exchange, single family home, roll the proceeds over to buy an office building. Vacant land, just sell it, roll your profits over to buy a duplex, which is considered residential. You have a condo, you made money on when you sold it, roll it over and invest it in a strip mall. You sell an apartment building and roll it over and buy a warehouse, right? That's commercial to commercial. Retail store, you sell that and you roll it over to buy vacant land. Okay? So commercial, residential, and vacant land, mix and match any way you like. All right, so the third person who's going to hold the money is called a qualified intermediary. The money's kept in an escrow account until it is transferred over to the closing agent at the time of closing. And the investor, you can't hold on to the money yourself. So the investor can't touch the money. It has to be kept with a third party. IRS recommends that you investigate this third party, because if they go bankrupt, then you're going to lose that money in the escrow account, and you're going to see in a minute you have a particular time frame in which to get this selling one property and buying another property. And if you lose that money in the escrow account, you're probably not going to get it back in time from the individual that filed for bankruptcy, right? You're going to have to get in line to file a claim against that person. Okay, so make sure they've been in business for a while, and that kind of stuff. The delayed exchange is the most common type of exchange. In this type of exchange, you have to close on the replacement properties after the sale of your own property concludes. So after the closing date of the property that you're selling, then you can close on the replacement property, as long as you close within 180 days after your own property sells. So the rule is 45 days after closing to identify one or more replacement properties, and 180 days to close on one or more. So you might want to already have properties pending if you're sure you want 1, 2, 3 or more. 1, 2, or 3 is the easiest way to go, and you'll see why in a minute. But you might already want to have those pending before the closing on your own property. And you might want to have them close halfway into that 45-day period, so if a deal falls apart, you still have time to identify a replacement property for one of your first choices. Okay? So if you actually manage to close on a property within that 45-day window, then you don't have to send that to your intermediary as a selection, because you've already closed, and the intermediary would have already transferred the funds from the escrow account to the closing agent in order to purchase the replacement properties. So you have two ways of IDing properties. The easiest way is to pick 1 to 3 properties regardless of value. You only have to close on one of the 3. If you want, you can close on all 3, but you're only required to purchase one of the 3 if you identify 3. Only have to purchase one of them. The second choice is a little bit more complicated. You can identify an unlimited number of properties as long as the total value of those replacement properties doesn't exceed twice the sale price of your own property. And you don't have to close on all of them, but you have to purchase 95% of the total value of those more than 3 properties that you identified. Okay, so that's the summary of this is you can benefit from the 1031 exchange by delaying indefinitely your paying of the capital gains tax. You need to use a qualified intermediary to hold the proceeds, and you can build up your portfolio of properties. And again, we said, benefit from the passive depreciation and the tax deductions. So go to irs.gov. You can read a little bit more about it. There's other websites that have details about the different versions of an exchange. Contact your CPA or real estate attorney for additional information. Okay, so that's going to do it. Thank you.